Well, let's get talking. Nigeria's inflation slipped slightly by 0.03% in January, following the hike in the December figures, which was attributed to the upsurge in the demand of commodities. The decline follows an increase in December 2021 to 15.63% after an 8-month decrease between April and November 2021. Although food inflation declined in January, it remained elevated at 17.13%. Meanwhile, core inflation stood at 13.87% in January, higher by 2.02% when compared to 11.85% recorded in January 2021. Let's now analyze the factors contributing to the drop in price of commodities as against the realities, of course, in the market. And joining me to do this is no other person than a professor of capital markets at Nasarawa State University, Professor Uche Uwaleke. Good afternoon, Prof. It's very good to see you.
Yeah, good afternoon, Tolu. My pleasure indeed.
Yes, I know very interestingly, coincidentally, the GDP figures also came out this morning. But before we go to that, which I know one way or the other our discussion might relate to that, what is your reaction to the decrease that we saw in inflation in the month of January, following what we saw in December?
Yes, of course, what we saw in December, one could attribute to, seasonality factors. The fact that usually in the month of December you would expect, an increase in the general price level owing to the festivities. So it's not surprising that December figure came in at 15.63, much higher than what we had in November. And January, we are now witnessing, marginal slow, or if you like, moderation in inflation rate. So that of December was clearly due to seasonality factors. Again, it's also cheering, I would say, that even though you said we'll talk about that later, that the GDP figure is still positive. On the average for 2021, we are now talking about 3.4%. So that also means that the economy is gradually creeping out of stagflation. Remember, in 2020, the economy was largely, if you like, stagflated. It's a situation in which you had very weak growth. As a matter of fact, remember, in 2020 we had a recession and rising inflation. That was clearly stagflation. So with GDP figure, becoming a lot more stronger, despite the fact that we are having the base effect, weakening. So that's cheering. But however you look at it, I must say the inflation figure of even at 15.6 is still high, is on the high side, given that the CBN target is just between 6 and 9%. So we are still far from single-digit, inflation. And of course, the negative impact that inflation has. Maybe I should mention a few of them. Purchasing power is eroded, especially for those on fixed income. They find it a lot, very difficult. And that also goes to fuel poverty. High inflation rates, fuel poverty. And for businesses, it makes planning difficult, we also know there is a link between inflation, for example, and interest rates. Part of why interest rates are also high is also because of the high rate of inflation. Nobody will want to give out credit, for example, at interest rates that are below inflation. So as inflation is rising, you also tend to find interest rates rising. You can also argue that high rate of inflation discourages investments, in an economy, because of course no investor would want to have a negative rate of return. So it's important that return on investment stays above inflation rate. If you look at the stock market, for example, year-to-date return is in excess of 10%, but it's still below the inflation rate. And you could say that the real rate of return, using the market average, is negative. So that discourages investments. So inflation rate needs to come down if we need to have an improvement in investment in the economy, and more importantly too, perhaps something that a lot of people are not aware of. High rate of inflation also fits into exchange rate. Look at it this way: if you have rising inflation, your purchasing power is reduced. So what do? People tend to now resort to currencies, that are fairly stable, and that's why during a high, inflationary trend period, you would find that money, the domestic currency naira, loses its value in terms of storage. So store of value is lost, and people tend to go for foreign currency. That's why you now find exchange rate rising, because a lot more people will now want to get dollars to have as store of value. So that affects exchange rates. Again, we know this is supported by theory. In theory, there's what we call the purchasing power parity. And under the relative measure of purchasing power parity, it says that exchange rate is a function of a foreign currency, the ratio of a foreign currency to the domestic currency. So you find that inflation rate, has a negative impact, however you look at it, on the economy. And that's why it's important that the high rate of inflation must be tamed, for the economy to really grow inclusively, such that a lot more people, feel the impact of the growth, relative, if you like, growth that is being witnessed now.
Brilliant. Prof, now you've talked on the monetary side, the effects on monetary side and investments. Let me ask you straight up that with what we have, with the figure we have at the moment, what message do you think this will send? One, to the monetary side, what decisions do you think they might be thinking of maybe shifting their ground at the moment with regards to interest rates? And do you also think that this will encourage investments? Talking about investors, bringing them in at this time with where we stand with inflation and all of these figures in.
Yeah, of course, the monetary authority, the central bank, is worried about the high rate of inflation. If you notice, at every MPC, Monetary Policy Committee communique, that is usually an issue. And I'm also sure during their next scheduled meeting in March, it will also come up. The inflation figure for February, may have come out by then, and that will be an issue. What we have now is that of January, and I expect that by February, the inflation rates, should continue along this trajectory, should slow down, a bit. Other factors remaining same. Now, I see the monetary policy stance changing, with time in the course of the year, and that's because the central bank the Monetary Policy Committee will be also considering the risks, the risks to the inflation itself. And if you look at these risks are still there. The question to ask is, what are even the factors that are fueling the high rate of inflation in Nigeria? Tolu, they are not demand-side factors per se. It's not a case of having too much money, chasing too few goods. Even if you say you have too much money in circulation, you find that this money is in the hands of a few, and to that extent, it doesn't really, the pass-through, to inflation is weak because it's in the hands of a few. And that's also because the propensity to consume for the rich, appears to be, studies have shown that the MPC, propensity to consume, for the rich is low, lower than that of the poor. One way to also know this income disparity is to look at the quantum of bank deposits. We often hear that, is it 80 or 90% of bank deposits, are accounted for by just 10% of depositors. So that tells you the income inequality. So even when you have much money in the circulation, it's not fairly distributed. It's in the hands of a few. So to that extent, the inflation challenge we're having is not demand pull inflation, if you like. It's not the demand side factor that is causing it. So it's more of a supply side. It's more of a cost push factors. And that the central bank recognizes, which is why most of the time you hear that monetary policy tools are already overstretched. There's a limit to what they can do because it's not demand driven. So if it is cost driven, then we'll look more to the fiscal side. Inflation rate in this country today is being powered by or being driven by factors such as high cost of energy. Recently, fuel scarcity has emerged once again, but I'm happy to hear that in a few days' time that will clear. We also have high cost of electricity, and then high cost of transport. Of course, high cost of energy fits into high cost of transport, and of course, weak infrastructure, generally. So when you have all that, and tied to that too is the issue of insecurity. Remember, the food inflation is where the heat is coming from. By the MBS figure, the food index was 17.1%, down from 17.3. As a matter of fact, the reduction we had in January, compared to December, came from the food side because the food index dropped. There wasn't any change at all in the core components, which was 13.87, also compared to what we had in December on a year-on-year basis. So it was the food that actually accounted for that reduction. So insecurity, we know, is a factor there because of the fact that farmers are not able to go to farms and so on. So there are more of, as I said, structural bottlenecks, supply side factors, cost push factors, and that's why the attention should be on those factors, not necessarily the demand side, and which is why the central bank is using more of activating more of its developmental finance functions, interventions in the agri space, to be able to shore up food output and then tame inflation that way, which is also why we are seeing the fiscal side, for example, trying to also borrow to put in infrastructure, because infrastructure, is key to reducing the rate of inflation, that we have in Nigeria. And I also think that, of course, you also know exchange rate is part of it. The higher the exchange rate, because we are an import-dependent economy, you also have imported inflation, contributing to the high cost of, goods and services. So if exchange rate is low, you should expect that to also have the positive pass-through to inflation rates, which is why I was happy when I read that the central bank is embarking on a very, if you like, huge project that is called RT 200. That is the race to $200 billion forex repatriation to Nigeria over between 3 to 5 years' time. And I'm sure in the medium to long term, inflation rates in the country will come down if that policy is well implemented. Because what it means is that if we have that huge quantum of forex coming into the country, you can be sure that the naira will appreciate. You can be sure that exchange rate will come down. And if exchange rate comes down, inflation rate is also bound to come down. So it's important that that is pursued aggressively. Remember too, part of the component of that RT 200 is the emphasis on value-adding export facility, in the sense that before now, the country has been exporting raw agri products. So when you export raw yams, you export raw cassava, you also cause food inflation. You contribute to food inflation within the country because you're taking out these food items. But what is happening, what the central bank is talking about, my understanding, is that instead of exporting them raw, these items will be processed, and only processed to finished products that will be exported. And of course, they will command more value when you process and export them. So again, that will, as I said, go a long way to reduce the inflationary pressure, because the items that are being exported will remain here, more or less, and then it is the processed version of those items that are exported. So I think, by and large, some of the policies that are in place now will go a long way to tame the inflation rates in the medium to long term. But in the near term, we may not see much happening. Inflation rates will still be high. Remember, in the 2022 budget, the government is targeting 13%. In the 2023, if you look at the medium-term expenditure framework, 2022 to 2024, the target is 11% by 2023 and 10% by 2024. So what that means is that we may not see single-digit inflation rates until beyond 2024, even by the estimates that the government, has. And
True.
as I said earlier, until we have single-digit inflation rates in this country, especially within the band that the central bank has, specified, economic growth may not be. We may not get an inclusive economic growth. By that I mean the one that the ordinary man in the street, will feel. Okay, we may be growing as long as inflation rate is high. That growth may not really touch on the ordinary Nigerian, in the street there. So it's important we curb inflation, we tame inflation, and at the same time also grow the economy inclusively.
Now, Prof, before I let you go, yes, the hot one, very, very hot. It's what we are grappling with at the moment. It just came out. The NBS just released it earlier today. 3.9% growth for the fourth quarter of 2021. Something that is also very significant here is the fact that the non-oil sector is putting 94.81%, contributing that to economic growth. How does this come to you?
I'm not hearing Tolu again.
Prof, you can't hear me. Hello, Prof, can you hear me?
Of the question that you asked, but I didn't really get that.
It's on the GDP.
If I may conjecture, we are still on the subject matter, inflation. I'm sure you can hear me. I wasn't hearing you. I didn't hear the last part of the question. But the point
Prof, can you hear me now?
Maybe it's important emphasize is that inflation challenge in this country is not something we leave for the central bank. No. Yes, the central bank has the primary responsibility of maintaining price stability, but the drivers of inflation in Nigeria, require that the fiscal authorities must play very critical role. So it's a case of having a handshake between fiscal and monetary policies, yes, with respect to taming inflation. So it's not a matter of central bank. We can't say central bank should take up the entire responsibility. As I said, because of the factors driving inflation, in Nigeria. And as I said earlier on too, the efforts in the area of infrastructure, in particular roads, rails, ports, these are very critical if you must bring down inflation rates in Nigeria. And again, remember too, I talked about energy, fuel. So it's also important we get to a point where we are able to refine all the fuel that we require in this country. Because as long as we continue to import fuel and we expose the country, if you like, to the vulnerabilities of the international oil market, we may not be able to also have a handle on that. So for us to be able to control inflation, we need to be able to, sort that supply issue with respect to fuel. We need to be able to get to a stage where we should at least refine enough domestically. And I'm happy that the Petroleum Industry Act has been passed. It's just that aspects of it now are going to be deferred. But that act is meant to attract more investors into the sector, and as we have more investors and it becomes competitive, so I also expect that the price of petroleum products should come down. The type of thing we saw in the telecoms industry. So if price of petroleum products come down as a result of competition, you should also expect that to feed into the price of goods and services. But there is something I want to say here, Tolu, and that also has to do with the fact that if you look at the methodology that the MBS is using, their base period is 2009. MBS is relying on information from informants across the country. According to them, 10,554 informants. And MBS is using 740, goods and services in the basket. Of course, they have weights attached to them. I am of the opinion that it is time we revised that, methodology, such that whatever figures we are bringing out in terms of inflation rate, then it reflect, the reality. I say that because if you look, the recent figure they released said inflation rate was highest, food inflation rather, was highest in Kogi State at over 22%, and least in Sokoto State at over slightly 14%. If you look at their report, but every month I have the privilege of getting the inflation figures released by the Kogi State Bureau of Statistics. Kogi State has a Bureau of Statistics. I get what they release every month by way of inflation rate, and it's usually not in tandem with that of the National Bureau of Statistics. Kogi State is using 2021 June as their base period. Kogi State is using 190 goods and services, about the same methodology basically of computing index, the last payers method. That's what Kogi is using, and then MBS is using. So I'm saying that it's important that the MBS, should try to update what they have. If it means expanding the number of informants, or taking a second look at the weight attached to the goods and services in the basket, as well as also, using something that is a lot more recent in terms of base period, as opposed to using that 2009. So that's my recommendation. The MBS should consider, in updating or revising the methodology that is currently being used. So we don't have much divergence between what they are releasing and what we also find other independent people, doing. Let me also say this, that, I was talking about medium-term and long-term, prospects of lower inflation rates. But in the near term, we will still have to live with that. And that's partly because of what is happening now in the U.S. In the U.S., Tolu, inflation rate is trying to hit the roofs, their own roofs. Inflation rate for January, as released by the U.S. Bureau of Labor Statistics, jumped to 7.5%. That's the highest in 40 years. Okay, so what that means is that the U.S. Federal Reserve is now almost, ready to hike rates in the U.S. because of the rising inflation. And if that happens, we also expect that should reverberate, if you like, to not only to emerging economies, but including frontier markets. Nigeria, of course, will be affected because that may lead to, if you like, capital flow reversals. And when that happens, our economy too will be affected, and indirectly too, that will also hurt, or if you like, also affect inflation rate. So inflation rate is likely to remain high because, as I said earlier on, if that happens in the U.S., is increasing in the U.S., the central bank here will have no reason to reduce the MPR. In fact, the central bank may think of increasing the monetary policy rate because of the developments in the U.S. in order to stem capital flow reversal. And of course, if MPR is increased, the banks will reprice their assets, number one, interest rates will go up, cost of funds will go up, and when businesses too experience high cost of funds, they shift that to ultimate consumers. So you see the link between all this, especially in the near term. So it's important we understand these developments and then get prepared for them, and also see how we can put in place measures to mitigate their possible impact.
All right, there. It's a good way to leave it, Prof. I must thank you. Interesting conversation there, at least breaking it down and also talking about global issues and how this affects Nigeria. I've been speaking to a professor of capital markets, Professor Uche Uwaleke, there at the Nasarawa State University. Thank you so much for spending your time with us. He joined us live from our Abuja studios.